Take a look at this chart here. It's a large database of stocks, and you'll notice that the technology sector, services, consumer goods, basic materials, healthcare, industrial goods, and utility stocks are majority in the green. However, as we make our way towards the bottom left-hand corner of the chart, we see a blob of red. This blob of red is under the financial sector. More specifically, under money center banks. It includes stocks like Bank of America, JP Morgan Chase, Citigroup, and Wells Fargo. So I'm here to explain to you why this is and why the big banks are in trouble. This is StockerFinance, and I'm your host, David Scheuer. Tweet me questions at StockerFinance or comment them down below. To summarize my theory, it all lands on one issue, and that's loan defaults. This simply means that people and businesses aren't paying their loans, which hurts banks since they're the ones who lent out the money and now aren't receiving their money back or the interest owed to them. The current epidemic has caused businesses to shut down as well as mass unemployment. Over 22 million people have lost their jobs in the past month, and the real unemployment rate is nearing 18%. To put this in perspective, in 2008, the unemployment rate was around 5.8%, and the highest state unemployment rate was Michigan with 8.4% unemployment. The Great Depression had an unemployment rate around 24.9%. The 2008 recession changed the U.S. banking system dramatically. There were banking failures and consolidation, reducing the number of banks in the U.S. from 8,743 in 2006 to 5,177 in 2019. Even though there's a lesser number of banks, this smaller number has added trillions of dollars in assets. Total assets in banks in 2006 was at 11.8 trillion. Today, it stands at 18.6 trillion. The ratio of non-performing loans, and that basically means loans that are 90 days past due, to total loans, and the ratio of net charge-offs, which means debt on loans unlikely to be recovered, to total loans, are at lows for the decade. However, they still are higher than they were in 2006, and I believe they will, and already have, increased dramatically. An article here from the Motley Fool states that, in one instance, you could argue that because there are more charge-offs now, banks might be more conservative and strict when it comes to their judgment of credit. On the other hand, the uptick in charge-offs and non-performing loans could simply be a result of banks today issuing more commercial loans, which are inherently riskier than mortgage loans. That last sentence, charge-offs and non-performing loans could simply be a result of banks today issuing more commercial loans, which are inherently riskier than mortgage loans, is a major reason the big banks are in trouble now. Single-family mortgage loans decreased from 2.7 trillion to 2006 in 2019. Multifamily increased from 193 billion to 458 billion. Commercial real estate increased from 866 billion to 1.5 trillion. And commercial real estate, the riskiest of them all, increased from 1.2 trillion in 2006 to 2.2 trillion in 2019, a near $1 trillion increase in some of the riskiest loans a bank can give out. The issue is that they gave out the most loans to commercial and industrial, but now businesses are closed, earning no revenue, and aren't going to be able to make their loan payments. The banks gave out $2.2 trillion in loans to businesses who now can't pay their loan. This means less interest revenue for banks and a massive loss of cash. That's just businesses too. Many people who got laid off won't be able to pay their mortgages and will ultimately stop paying their mortgage or their rent, which means more landlords will be unable to pay their mortgage. Mortgage delinquency rates during the last recession were around 9.3%, but remember that the unemployment rate was only at 5.8%. Now the unemployment rate is nearing 18% and climbing. There's no telling how high the mortgage delinquency rate could be now. But if the mortgage delinquency rate was double the unemployment rate like it was in 2008, then we could potentially be looking at around a 40% mortgage delinquency rate now. Keep in mind, though, that the 2008 recession was also very different compared to what we're going through now. Small businesses were still in operation, and people were still able to go outside, eat at restaurants, go to malls, and travel. Now we're mostly stuck inside. I now have some extremely poorly written graphs to show you. Even though they proved to me that my artistic skills are lacking, I believe they will still get the point across. The first graph here shows the loan defaults in relation to income. On the y-axis, we have less income at the bottom and more income at the top. On the x-axis, we have less likely to default on the left and then more likely to default on the right. The point of this simply is to prove to you that the less income you have, the more likely you are to default on a loan. The next poorly drawn graph I have to share with you is interest rates in relation to the number of loans being given out by banks. It shows that the lower interest rates are, the more loans tend to be given out, since people and businesses want to take advantage of the low rates. Now, at the beginning of the coronavirus epidemic, at least the beginning of it here in the US, the Federal Reserve cut interest rates to nearly zero. So what happens when the interest rate is at zero or near zero? Well, a zero interest rate policy is when the central bank sets its target short-term interest rate at or close to 0%. The goal is to spur economic activity by encouraging low-cost borrowing and greater access to cheap credit firms and individuals. To sum this up, it's saying that it's encouraging borrowing and taking out more loans. Now, if we combine the two graphs I was talking about on the same chart, you'll notice that when people have more income and interest rates lower, they tend to take out more loans since the probability of them defaulting is lower. At the beginning of the coronavirus, the U.S. businesses and individuals probably thought it was a good idea to take out more loans in order to keep people on payroll or keep their businesses open. Banks actually encouraged people to take out loans since that's how they make their money and since interest rates were lower and they knew people would want to take advantage of that. However, many who took these loans out didn't expect the economy to be shut down for so long. So after a while, businesses realize that their loan has run up, they have to lay off workers anyways, and now they've run out of cash to pay the loans they took out. The next graph shows loan defaults in relation to time. As time goes on, we will see more and more loan defaults. The mortgage delinquency rate will increase and bigger loans will be defaulted on. Remember, the banks nearly doubled the amount of commercial and industrial loans given out since 2006. The banks never expected to have this problem occur or to last, so they just kept giving loans out. Now, many will default and the banks will lose millions in unpaid interest and will most likely not be receiving many of their loan payments. Now we look at today. A recent headline stated that Bank of America posted a 40% drop in profit and the other banks are following suit. Bank of America stock is now down over 10% today, and other banks are following in their footsteps. So will the banks survive, or will they be bailed out once again? Or will they be forced to shut down? No matter what the outcome is, it's a grim time to be a bank. Thanks for watching. Please subscribe and make sure to check out these videos as well. If you want to help support this channel, please share the video and give it a like, as well as click my link below to start a Robinhood account. It's simply an affiliate link that will get you a free stock and me a free stock when you sign up and deposit some money. Thanks for watching again. This is StockerFinance. I'll see you guys in the next video.